Hello, everybody. It's Professor Reiko here. Today, in this lesson, we are going to walk through some transactions and how they affect the accounting equation. So, this is the second lesson for the accounting cycle. Our previous lesson, remember, we kind of introduced the accounting equation, which should have been reviewed, assuming you are an intermediate accounting student. We introduced the accounting equation, talked about normal balances and things like that. So now what we're going to do is just walk through transactions and how, not putting them in journal entry format, just walking through how they affect the accounting equation. All right, so you can see all this is just an example, so we'll just go through together and do this. All right, so for each one, we're just trying to figure out what affects the accounting equation. All right, so I'm going to spread that out a little bit. All right, so if we issue stock for cash, all right, so anytime you're doing a transaction, for me, I just, tell students, just talk through what's going on. All right, and anytime you see cash, that's always an easy place to start. Now remember, assets are normal debit balances, liabilities are normal credit balances, and equity or accounts are also normal credit balances. All right, so it says we issue stock for cash. All right, so we're receiving cash. All right, so that means assets are going up by 27,000 in the form of cash. All right, so the flip side of that is we issued stock. All right, so we'll call this common stock, assuming it was common stock. And that also went up by $27,000. All right, so you can see our assets increased by 27 and our equity increased by 27, so giving us an overall, the accounting equation still holds. All right, so let's look at the next one. The next one says we purchased equipment for $78,000. All right, so once again, just sketching this out, giving myself room to write in the blanks here. All right, so notice here it says we purchased equipment for cash. All right, so this means we are paying cash for it. We are buying an asset, we're paying cash. All right, so that means cash goes down by 78,000. All right, I'm just going to write it right here to the side of it. All right, so cash goes down by 78,000. However, equipment is also an asset. All right, so we also increase our asset account by increasing for equipment. All right, so notice here we don't have anything affected on the right side of the equal sign, meaning liabilities and equity are not affected, only the asset side, but it increased by 78 and decreased by 78 at the same time. Thus, the accounting equation still holds because it's essentially 0 equals 0 plus 0 as our overall effect. All right, the next one, we purchased land and signed an $87,000 promissory note. All right, so assets equals liabilities plus equity. All right, so a promissory note, we'll just call that a note payable. That just means you as the purchaser are signing a note saying you agree to pay back the amount. There's probably some interest involved and things like that. We'll get into notes payables later on when we get to the liability section of our lessons. All right, so for this one, we purchased land, okay? So we increase our assets by 87,000. All right, and the account would be land. All right, on the liability side, we're increasing our liabilities through note payable. All right, so liabilities go up. So sometimes students are thinking that should be a negative because we're going into debt. That's true, but the note payable account is a liability account. That says that we do, what that means is anytime you see payable, it means we owe something, right? So before this journal entry or this transaction, we owed 0. And now we increased our liabilities by 87,000 to reflect that we now owe 87. So once again, the accounting equation holds, so we're still good moving forward with this. All right, so our last few here. All right, so notice the next one, we sold land and received a note receivable of 61,000. And you notice here in parentheses it says the land had a book value of 61. That said, I put it that way just so there's no gains or losses on the transactions. We'll get into gains and losses later when we get to our fixed asset chapters and we start selling fixed assets. All right, so once again, what is the effect on the accounting equation? All right, so if we sold land, that means land has to be going down or decreasing. All right, so land is decreasing by 61,000. All right, and I tell you what, let me just do this real quick. Probably should All right, let me switch back. I'll just put it land to the side because actually the two accounts that are affected are both asset accounts. All right, so we sold land, so it goes down by 61. All right, and notice we received a note receivable. So what that means is kind of like the opposite of a note payable. We sold something, and the party that we sold it to is going to pay us back later. So on our end, it's a note receivable. On their end, it's a note payable. All right, so any type of receivable is an asset. Okay, so what we see here is our assets are going up by 61,000 for the note receivable. All right, so this is another example where only assets are affected, but the accounting equation still holds. All right, the next thing is we earned 30,000 in revenue for services performed to be paid in 1 month. All right, so a couple of key terms. Whenever you're looking at transactions, notice it says to be paid. All right, that means we did some work for somebody, which is revenue to us. However, they haven't paid us yet. We will bill them and they will pay us in a month. All right, so keep that in mind here. So we have assets equals liabilities plus equity. All right, so since we haven't been paid, we have a receivable. We just call this accounts receivable. So that's an asset. So we have an increase in our assets by the accounts receivable account. All right, so now we have revenue. Okay, so notice revenue, if you look back at the prior lesson when we were we expanded the accounting equation. Now remember, equity, one of the main equity accounts is retained earnings, and retained earnings is net income increases retained earnings, and revenue is a part of net income. So if you're not clear on that, go back and watch that the accounting cycle 1 lesson, and you'll see as we expand the accounting equation, we expand the equity section out, you'll see that. All right, so equity goes up by 30,000. All right, and the account is revenue. All right, so let's just kind of track this process. All right, so revenue increases net income. All right, net income increases retained earnings, and then retained earnings is a component of stockholders' equity. So if retained earnings is increased, equity is increased as well. So SE is just stockholders' equity or shareholders' equity, you might see it called. All right, so revenue does affect equity. It increases it. It just does it indirectly. All right, next one, purchase supplies on account for 3,000. This is another one. Look for the keywords, on account. All right, so that's we are buying supplies, but we're not paying for it now. We're going to pay for it later. All right, so when we're looking at our accounting equation, we purchase supplies. All right, supplies are an asset, so we'll increase our asset by 3,000, and that account is called supplies. And then since we haven't paid for it, so if we paid cash, we would just have a decrease of 3,000 for cash, but we haven't paid for it yet. So we're going to increase our liabilities because we now owe $3,000, and we call that accounts payable. All right, and then our last one was we paid a dividend of 6,000. All right, so dividend is another one that affects equity through retained earnings. So let's just kind of sketch this out here. The accounting equation, assets equals liabilities plus equity. All right, so we paid a cash dividend. All right, so always use key words here. Paid, that means cash is going out the door for paying. So we have a decrease in $6,000 of cash. All right, and then on this side we also have a negative 6,000. All right, so let's just sketch this out. So remember, dividends reduces retained earnings. Okay, it reduces retained earnings, which means it's also going to reduce our stockholders' equity account. All right, so up here, maybe I should have put that net income increases retained earnings, which will increase our stockholders' equity. All right, for that example with the revenue. All right, but remember, dividends also affects retained earnings. All right, I guess it's worth sketching this out again. I'll just put this to the side. So ending retained earnings equals beginning retained earnings plus net income minus dividends. All right, and then you remember net income is essentially revenue less expenses. So we can see revenue increases net income, which will increase retained earnings. That's what we saw up here. And then dividends right here decreases it, and that's what we see down here. It decreases equity. All right, so this is just, we could go on and on with this, but, if you're an intermediate student, this should really be reviewed. If you're just taking a principles course, this might be new to you, but you got to have this foundation, understanding what accounts are affected, all right, how they affect them, if they're increasing or decreasing, how that relates to the accounting equation. And then that will make things easier as we move forward and start putting things into journal entry format so that we can eventually prepare our financial statements. So this finishes this lesson. The next lesson, we'll start the accounting cycle and start looking at journal entries and things like that. So I hope you enjoyed the video. If you do, please hit like. Please subscribe to my channel. I appreciate any feedback or comments you might have. And hopefully you'll enjoy the next set of videos that I'll do as we continue to work through the accounting cycle.